We have Diana Mousina, the senior economist from the AMP, to lead us out and talk to us about what's happening in the world. Diana.
All right, thank you, Nathan, and good morning, everyone. It's a pleasure to be here today. My job today is to set the scene about how we see the economic outlook at AMP and also, of course, how that fits into the investment universe and what it really means for markets. My update is, unfortunately, it's not going to, I think it's so easy to paint a really negative picture of the outlook right now and say we're about to go into a recession. I think that's kind of a bit of a sellout at the moment because it might sound good when you're talking about all the risks and you might sound really convicted about that view, but I think that the issue that we're having at the moment is that most people are really uncertain about where the future's going to go because we have a lot of dynamics at play that mean we can go down the path of a downturn or a recession because there are these growing risks and central banks have hiked rates so much. But more probably, we're just going to continue in this environment where growth is slowing, interest rates will slowly be cut, and you kind of just have this weakened growth environment. Now, that's not necessarily bad for equities or for growth assets, and that's really the point of today's presentation is that I think we are going to be in a bit of a sweet spot for the equity market in the next 6 to 12 months. So that's my disclaimer, which of course just says, I wasn't here and you can't listen to anything I've said. You have to see your financial advisor if you want any more detail about investing. So where are we at the moment? What's the state of play? We've obviously had a very big rebound in share markets, both in the US, but also in Australia towards the back end of last year. And that's come at a time when the growth environment has actually been quite constrained. If you think about world GDP growth, which is that right-hand chart there, it's actually not running at very strong levels. We're actually running below average at the moment. But share markets haven't really responded to that. And despite the fact that we've had all these rate hikes, US share markets have gone to a record high and similar in Australia and in the Eurozone as well. So why has this happened? It's really been down to a few reasons. The US share market, of course, has that big exposure to the tech sector, which is about 40% of the S&P there, and that's been continuing to rally on strong profit growth, but also expectations that AI will improve long-term productivity growth. That probably has a bit more to go in the short term, which is why we think that US share markets will probably continue to outperform Australia in the next 12 months. There's also the current environment that we're in, which I kind of mentioned before. Growth has weakened, but it's not really falling off a cliff. Inflation's coming down, and central banks are likely to start cutting interest rates soon, which is what has continued to propel share markets further. And this type of environment we think can continue at least for the next 6 to 12 months. If you think about the state of play for inflation dynamics at the moment, I often look at this chart and I think we were so concerned that inflation's going to stay high for so long. But what it shows you is that just as quickly as inflation went up, in 2022 and 2023, it's actually come down at a really fast pace. If you look at countries like Australia, US, where inflation peaked at about 8%, maybe a little bit over than that, it's now come down quite comfortably to 3.5%. And there is further downside to go if you look at things like goods prices and also some of the supply chain pressures. We think that there's going to be more downside to inflation, particularly on the goods sector. There were some concerns earlier this year around an increase in supply costs due to what's happening in Israel and the Middle East, but that hasn't really translated through into container or transport costs. So we think that goods prices will continue to slow, and on the services sector, the key to that is really what's going on in the labour market. When you start to see a slowing in wages growth, that should really be the start of a further slowing in services inflation. In Australia, we get quite concerned, I think, here that Australia is different to the rest of the world in terms of what's happening to the services sector. We continue to think that services prices here will be quite sticky. But when I look at the main components of services here, the ones that have been driving inflation in the past 12 months, it's really been around eating out and holiday travel. And if you look at spending volumes on things like eating out and holiday travel, they've actually been negative in the past few months in Australia. And as the pressures on the consumer, high inflation, interest rates, and the drag from income taxes or bracket creep will continue, it's hard to see spending volumes increasing significantly for consumers here. So I think that the pressures of high inflation for things like eating out and travel are going to continue to slow. Rents are still elevated here. That's really a factor of the fact that we have a lot of housing undersupply. We're importing too many people, and our population growth numbers are running at around a record high, 2.5% per annum. That's way too high for Australia at a time when you have such constrained housing supply. If you think about how many houses we're building right now, we're building about 160, 170,000 new homes a year. But based on population growth, we need to be building close to about 220,000. And the government's National Housing Accord policy actually says that they want to be building 240,000 new homes a year. I just don't know how they're going to get to those levels given the current rates of construction and the fact that the building industry is still under a lot of pressure in terms of labour and materials. So the rental component of services inflation will probably remain quite elevated, but even when I look at new asking rents, so if you go into the market right now and you're trying to get a new dwelling for rent, the pace of growth for that has come down. And of course, what's happening in the labour market? So in Australia, we actually get the employment figures today, but we've seen an increase in the unemployment rate. We had the unemployment rate here bottomed at 3.4%. Now it's at about 4.1%. So it's actually been a decent increase. If you look at underutilisation, which is that left-hand chart, underutilisation is people who want to work more hours in the labour market, whether they're underemployed or unemployed. And you can see that that has started to shift up both in Australia and the US. And that's translated through to some slowing in wages growth. When you look at Australia compared to the rest of the world in terms of wages growth, that right-hand chart there, you can see that Australia has kind of lagged the rest of the world. We have a lot of inertia in our wage setting system here. About 60% of wages here are tied to awards, EBAs, or minimum wages. And those agreements are mostly tied to what the Fair Work Commission sets in June when they meet. That actually has quite a strong translation through to award and to EBA wages because it's a signalling effect. Last year's big increase to minimum and award wages sent this signalling effect to the rest of the market. Well, maybe I should be also demanding a larger wage rise. So we've kind of lagged the rest of the world in terms of wages growth, but it does look like we're at a peak because as the unemployment rate increases from here, it will be difficult to see those same wage gains continue, despite the fact that you may hear some reports about like the aged care workers who got another 14% pay increase. I mean, that's for about 300,000 people. They got a similar increase last year. So the contribution to wages growth is not going to be as high as it was last year. So we see wages growth slowing to about 3.3% by the end of this year. So this environment of slowing wages but soft growth means that central banks are probably around their top. I mean, it's hard to see another rate rise in any of the major developed countries, apart from Japan, of course. But the next move is very clearly going to be down for most central banks. It's just a matter of when that happens. The Fed meeting yesterday confirmed that the Fed's still on track to start cutting interest rates. They themselves haven't changed their view about cutting interest rates by about June. And when you look at their dot plot, their future expectations of interest rates, they're still expecting about 3 rate cuts this year. They've explicitly said that they want to start cutting interest rates this year. Other central banks, like the RBA, is not talking about rate cuts right now. But if you read the statement on Tuesday after the RBA meeting, the RBA has moved to a neutral bias on interest rates. So they've said they're not ruling anything in or out. I mean, I know it's a bit of a cop-out. I think that they don't want to give any forward guidance because of the issues that happened with Phil Lowe, but it is a neutral bias. It's the bias that happens before they move to an easing bias and then right before they move to outright rate cuts. So the RBA seems comfortably on hold right now. But we think that they'll actually start cutting interest rates by, our base case has been June. I'd say that the risk of that is now it gets pushed back into August, but our official forecast is that they will still start cutting by June, which is a bit ahead of where markets are pricing it to be at about September at the moment. When you look at Australia, you look at the changes to interest rates that the RBA has done. Australia's the red line here. We've kind of had middle of the range increases to interest rates compared to our global peers. But when you look at the change to our outstanding mortgage rates that actually impacts households, we've had one of the highest increases to outstanding mortgage rates. And the reason for that, I think most people in this room will be well aware. Australians borrow either for short-term fixed rates for 2 or 3 years, or they borrow on variable interest rates. So the change to interest rates that the RBA makes to your outstanding mortgage rate is quite quick compared to most other countries. If you look at a country like the US, you can see that they've had about a 0.5% increase to outstanding mortgage rates, even though they've had 525 basis points worth of rate hikes. So the flow through to the consumer here is arguably faster and stronger, which is why you're seeing that housing interest repayments in Australia have gone to, again, about a record high. And of course, that's translated through into lower retail spending and weaker growth. When you look at our backdrop of growth in Australia, it looks pretty weak. We've got annual growth running at 1.5% here, but our population's running at 2.5 or 2.7, which means that per person, Australia's actually going backwards. We've got a per capita recession, if you want to call it that. A per capita recession doesn't necessarily mean an outright recession. We've had lots of per capita recessions in the past. I've highlighted them all in these little bubbles here. But it does mean that growth feels pretty weak. And when you look at the pressures on the consumer, this right-hand chart here looks at the components of income that contribute to consumer spending. And you can see that the 3 main areas that have been dragging on consumer incomes in the past 12 months have been income tax. So the fiscal burden, bracket creep, has been one of the highest for consumers here that it has been for decades, because wages growth have gone up and the tax brackets haven't changed. That burden for consumers has continued to go up. Inflation has actually been the biggest drag on consumer incomes because it impacts everyone, not just those with a mortgage. And then, of course, the mortgage interest payments have gone up. Don't forget that not everyone has a mortgage. So about 30% of households have a mortgage, 30% own their home outright, and 30% rent. So if you don't have a mortgage, and you're not really impacted by those rising interest rates, unless you have a business loan or some other personal type of loan, but those loans tend to be at a much higher percentage relative to the RBA cash rate anyways. And this difference in consumer outcomes is quite evident in Australia. The banks report different savings by ages in their annual results, and I always find them really interesting to look at, because you can clearly see that the age brackets up to about 45 or 50 years have massively reduced their spending compared to a year ago. Their savings have gone down a lot. But the older households, those age over 55 who probably don't have a mortgage, they have maintained their spending and their savings rates are at still high levels. So we've seen this argument in the past 2 years that consumer savings are very elevated, which they are. So if you look at this left-hand chart, this looks at accumulated household savings since the pandemic. And you can see that that total household savings reached about nearly $240 billion. And that's only come down to about $170 billion now. So consumers have drawn down on their savings, but they haven't completely exhausted them. But don't forget that this is quite skewed to those older household groups that still have maintained their savings, haven't had to increase payments for their mortgages. So when we look at the household groups that we're most concerned about this year, it is those younger household groups that have a mortgage, family, and essential expenditure that they probably can't reduce. And I'm probably talking my own book there because I feel like I'm in that situation. But it just goes to show that there can be quite different consumer outcomes across the nation. When you look at retail spending data, it's slowed massively. Volumes are negative compared to a year ago, and clearly retail spending, even in nominal terms, is quite poor. And you can see that the retailers are saying this when they're surveyed in the business surveys. One of the reasons for why nominally Australia is still holding up so well, I made this point before, is our population growth has been so high. If you look at the number of permanent arrivals into Australia, so those on permanent or long-term visas, those levels are running at close to 600,000 people a year, which is a record high here. And that's actually continued into early this year. So the government did come out last year and say that they want to target student visas to try and be more stringent about students that go on to stay then and go into the labour market and work and then add to the economy and add to demand. But it hasn't really happened just yet. So, I mean, I think that we will see a slowing in population growth because of some of the more stringent visa announcements, and also because the Treasury themselves is forecasting slower population growth. But you do have to worry that this is a risk that will continue, and then it will further add to pressures in the housing market if we don't see that slowing in our levels of population growth. I don't have anything against immigration, of course. I'm a migrant myself here, but a long time ago. But you can't keep running these very high levels of immigration at a time when supply issues are quite constrained in our economy, both in terms of housing, but in other parts of the economy as well. And you can argue that the high levels of population growth have contributed to the elevated rates of inflation here. When we look at the pipeline of construction that's yet to finish in Australia, there is still actually quite a strong pipeline of residential work that's yet to complete. What's been interesting in this cycle, if you look at the left-hand chart, is that usually the number of dwellings that are approved then go on to mostly be completed. There's about a 90% completion rate. What's happened in the past 2 or 3 years is that while approvals surged during the pandemic after the housing policy made by the government, the level of completions has actually continued to trend down, which is what's led to this big pipeline of residential work that's yet to complete. So that it is positive from a growth point of view that residential construction will continue to add to GDP, but at the same time, you're not building those houses that have been approved, which is another problem for housing supply. And these issues with housing supply have created a situation where home prices have continued to rise despite the fact that we've had a 4.25% increase to interest rates, which would normally mean much softer home price growth. Most economists were forecasting about a 15 to 20% drop in home prices with the interest rate hikes, and we only got about 9% of that. So it's been a very strong cycle. The average borrower can now borrow about 30% less than they could before the RBA started hiking rates. So despite the fact that there's been that hit to borrowing capacity, which you can see here, the home price market has still continued to increase. And that again goes to this point that we've got too much housing under supply, and the marginal buyer is still having the sense of FOMO if they don't get into the market. So our forecast for this year is that home price growth will probably be between 2 to 5% per annum. So softer than last year. We had about 8 or 9% growth across the capital cities last year. The housing supply issues can mean that home price growth will be positive this year, but at a slower pace compared to last year. We've got the budget coming up in Australia in May. We're likely to see a very small wafer-thin surplus. The government's fiscal buffers have been boosted by the strong economy, high inflation, a low unemployment rate, and high commodity prices. Now, some of those things are turning now. So the surplus that we got last year is likely to be smaller because the economy has slowed and iron ore prices have been starting to come down in the past month. But the Treasury estimates themselves think that iron ore prices long-term will average about $60 or $65. So at $100 a tonne, the government is still doing better than its forecast. So the fact that the government's likely to announce a small surplus means that there probably will be some marginal cost of living relief in the budget. We are in a Labor budget, so I think that we are likely to see a bit more cost of living relief, but the government does have to tread carefully that they're not going to add too much to inflation. So I think that any relief will be quite minimal. The stage 3 tax cuts, I'm probably speaking to a room that was a bit upset by the stage 3 tax cuts. And from an economist point of view, I can see the fairness aspect of it and the equity aspect, but from a tax reform point of view, I think it was the wrong decision. Australia relies way too much on personal taxation. This right-hand chart shows you the share of tax revenue that Australia derives from personal taxes, and you can see that we're much higher compared to some of our OECD peers. So our level of the highest marginal tax rate starts at a level of income that's only about 2.5 times average income. In most other countries like the US, the top tax rate starts at a much higher multiple of average income. So there is definitely a need for the government to look into tax reform, not just personal tax reform, but more broadly for our economy as well, because long term we do have a structural deficit problem where we're relying too much on personal taxation, but also we have a lot of pressures on the budget, things like rising healthcare spending because of our aging population, high NDIS spending as well, and of course the higher interest costs because bond yields have gone up. So the government does need to address these issues and do some reforms to things like the GST, but it doesn't look like they're going to try and attempt to do that this year, let alone in the budget, unfortunately. So what does all of this mean for investment markets? So our overall philosophy is that growth will hold up this year, both Australia and globally. We do see global growth running below average. So average for the global economy is about 3% per year. We think growth this year will be close to about 2.5%. But despite the fact that we have this softer growth outlook, we've got inflation coming down, and central banks are likely to cut interest rates. Share markets, of course, like it when central banks start cutting interest rates if it's happening for the right reason. So if central banks are cutting rates because you're in a recession, that's not really a good outcome for share markets. But our base case is that we're not going to go into recession. There are definitely recessionary risks out there. Most of the time when you've seen high interest rate rises in the past, that has tended to be a mistake. And this is what I know a lot of commentators will say, that that this time is not different. You've seen all these rate hikes. There will have to be some sort of problem that occurs because of all these rate hikes. And if you look at the history of different crises, they're always usually preceded by very high increases to interest rates. But in our view, we're probably in a soft landing right now. The central banks have actually done quite a good job in getting inflation lower, maintaining growth, some increase in the unemployment rate, but the labour markets are still actually holding up quite well around the world. Job vacancies are elevated still, although not back to their pre-COVID levels, and the central banks have been able to maintain their gains in the labour market. So this environment, I think, does provide a sweet spot for equities and for growth assets, which is why we think that growth assets this year, so global shares and Australian shares, will still be able to return positive but lower levels of growth compared to last year. And for an average super fund, our average return forecast is about 5 or 6%, depending on the time frame that you're looking at. So still positive returns this year. If we get more signs that we're headed into a recession, then of course we would start to take an underweight position in our portfolios. But for the time being, the leading indicators are actually pointing to a rebound in growth rather than a deceleration. And if you're looking at earnings forecasts, which are actually a decent guide to the future of equity yields and also returns, earnings estimates are still holding up very well. More so in the US, even if you take out some of the major 6 or 7 companies in the US, earnings estimates are still holding up well there and positively. I mean, the major 6 or 7 companies have about 40% earnings growth forecast, and the other ones are lower, but they're still positive. In Australia, earnings forecast are slightly negative for the next 6 months, and then a bit of a rebound to about 5% from there, which is also why we think that Australian shares will probably not do quite as well as the US in the next few years if we're thinking about medium-term forecasts. So earnings growth numbers are quite important to look at. I mean, there are still obviously some near-term downside risks to shares. If you look at things like the equity risk premium, it's declined, so which means that you can get quite a good return on bonds relative to the risk with shares. So that does provide some negative risks to share markets in the short term. You could make the argument that share markets have gone too far and too hard, especially in the US, since the beginning of the year. And then if you look at things like investor sentiment, it's still holding up quite well, which can be a contrarian signal for share markets. So there are definitely some risks that you could see a bit of a pullback, but we don't think it will be a bear market pullback. You may see 5 to 10%, but we don't think that we're going down much further than that. When we think about bonds at the moment, obviously the tailwind from the fall in bond yields, which has happened in the past 40 years, so this kind of fall in bond yields that we've had since the 70s has provided a tailwind to growth returns, especially for things like infrastructure, real estate, and share markets as well. That tailwind is likely to be over because we are probably going to be in a world where inflation is not 3.5% or 4%, but maybe about 3%. So at the top end of the central bank's target, if you think about some of the longer term pressures on inflation, things like a rising budget deficit, an aging population, these factors generally mean that we are probably headed into a world where inflation is a little bit higher than where we've been used to. But at the same time, that period before the GFC was a bit of a strange period where inflation was barely 2%. That's not normal either. So that tailwind from bond yield returns has probably passed. But at the same time, when we look at our medium-term forecasts, they've actually gone up a little bit in the past 12 months, so our medium-term return forecast, as you saw in that other table before, running somewhere at about 5 to 6% for a balanced fund. You're going to hear later from Matt Gherkin from BCA, who I think is excellent about geopolitics. I mean, we often get asked about geopolitics and how it impacts our portfolios and how we're positioned. I think it's incredibly difficult to be positioned for geopolitical risks, because you can see this left-hand chart here looks at, it's a geopolitical risk index. So anytime that there's a newspaper or media mention of words like war, warheads, crisis, something about geopolitics, it tends to move around. So the biggest events, the world wars, the Russia-Ukraine war, Israel-Hamas, you can see that there's spikes there. But it's also extremely volatile. We tried to correlate this to the share market. There is no correlation to it whatsoever. When we looked at the major events in the past about what impact they had to share markets, I highlighted the ones that had the biggest impact. I mean, obviously, the ones that had the biggest impact, there was about a minus 10% impact to share markets from some of these biggest geopolitical events. But then a year later, share markets were up by, again, about 15%. So geopolitics can have a short-term negative impact on your portfolios, but in the long term, they normally, the portfolios tend to ride out some of these risks and issues. And at the same time, it's so hard to be positioned for them. So we think it's better just not to even be, I guess, involved in trying to position our funds to account for some of these risks. We get asked a lot, of course, about the US election this year. To some extent, I don't really think it matters who wins, because both parties have quite a hawkish stance on China, which will continue. I know Trump is talking about potentially putting on a tax of 20% on all Chinese imports, but the Democrats are quite hawkish as well on China. I don't know if Trump will actually go through with that, given it will mean higher inflation for the US and potentially no interest rate cuts, which is what he wants. So I don't know if that will actually be an outcome, and more just might be some rhetoric in his to support his base before the election. And at the same time, Trump is also talking about trying to reverse some of those tax hikes that are coming through in the next year, and that will be positive for share markets. So in terms of how share markets react to the election, I don't think it really matters who wins. I don't think that there will be a massive reaction one way or the other, because there are so many offsets to the potential outcome, even if Trump wins. I do think I mean, if you're looking at the polling right now, I do think that a Trump victory is a bit more likely at this current stage in time. Our medium-term return forecasts are listed here as well across all the different asset classes. We kind of touched on this before, so I won't go into that. As I said, we think that property will have small positive return this year in Australia. We're still negative on unlisted commercial property, and for equities, we still see low single-digit returns. I've got some time now for questions, which I'll be happy to answer. Thank you so much for your time.
Questions?
Look, I'll crack it off first. I think you made a really good case for why inflation should start to decelerate from here. What's the counter argument to lower rates? What's the risk that inflation could go higher? And then you kind of alluded it to here about the delayed reaction, especially in the US, of higher rates because of low mortgages. What if you have that delayed reaction come in and inflation kicks in? What happens then?
The main risks to inflation, I think, are that we see services inflation remaining high, and services inflation could remain high if the labour market holds up and you still see wages maintain at their, and in the US, wages growth is still running about 5%, which is very high. And if the consumer just continues to spend and doesn't really respond to those higher interest rates, you could definitely make a case for that right now. Retail spending in the US has slowed, but it hasn't fallen off completely. If the labour market continues to hold up, then you could see wages growth running at elevated levels as well. Of course, if we see a big increase in commodity prices around the world and transport costs increasing, that could lead to high goods inflation. That would ultimately just mean that the Fed would delay any potential cuts, maybe until the end of the year or into early next year. I still think that unless you got a big upward shock to inflation, which would mean that you'd see inflation running back at 4-5%, that would be negative for shares because it would mean that they would completely price out any rate cuts, potentially start pricing in rate hikes, but you really need a change in the growth environment to see that occur.
All right, we got one more question and then we'll move on.
Thank you. With geopolitical risk, the last slide, you mentioned that there isn't anything you can really do about it. And I know some articles we've read said usually you put your head in your sand, don't worry about it, just move on. But some other commentators have come out saying, when do you look at it, make it an issue? The second thing is, I've tried to access aerospace and defence stocks, ETFs and managed funds in Australia, and I can't get access. I've gone to the ETF providers, and they're all, we looked at it, but it's too difficult for us. And I've done some research on it, and they do extremely well, especially State Street. Global X have introduced it. I've been following that. That's been coming up nicely. So in a portfolio allocation, I would see a 5% allocation to it would give a good boost long term, and the returns, if you look at the State Street, are enormous. Thank you.
Actually, can I just, that example of aerospace, or as it happens, defence industries generally, actually an example we're going to be talking about specifically in the direct indexing session later on today, for exactly this reason, accessing a broad exposure to a sector you happen to like. So.
Yeah. In terms of, I guess the second part, I don't really know what the answer is to not being able to access it. I mean, you could invest in the individual stocks if you knew the breakdown of the index, which is probably what you'd want to do, or invest in something. Gold, FX is, I think, just so volatile. It's difficult to make the case that it could move one way or the other with a geopolitical risk. But I would say to try and invest in the individual stocks that you think are more of like a defence play. But in terms of the first part of your question, bury your head in the sand or not, I think it depends on the event. So with something like the Russia-Ukraine war, that did actually have a long-term impact to markets from the point of view that it was inflationary. With something like Israel and Hamas, there was a short-term reaction with share markets. I think that they fell by about 5% peak to trough. But again, with geopolitics, it's so hard. Like when we were looking at the impact to markets, it's really hard to know when a share market's responding to that event or when are they responding to something else. And it's so arbitrary. So a lot of geopolitical analysts, can fiddle with the numbers when they see fit. I mean, what date do you assume that share markets responded to that? Was it the day of the event? Was it the day after? Sometimes share markets don't respond to an event for days because they don't really know what to make of it. Sort of like with the US election, you may not see you may see an instant response, and then the response a week later from share markets could be something different, which is exactly what happened with Trump last time. We saw a big negative at first, and then we saw a big bounce back in share markets as they thought, oh, actually, we're going to get all these tax cuts coming through. And the same thing with geopolitics. We would think about it as, does this change the long-term philosophy for how we see growth? I think Russia and Ukraine was a good example of that it actually led to long-term inflation and was one of the reasons for why we saw continued increases to commodity prices. So it does depend on which particular event. So you can position your portfolio, but sometimes it's better to position it for after the actual event occurs because you just don't know what impact it will have. Thanks so much. Enjoy the rest of your day.
Thank you, Diana.